Safe markets, getting ahead of the curve.
The worst economic downturns in the United States have come from asset market bubbles, particularly land or real estate. These bubbles have a cyclical nature and repeat every 16 to 18 years. The last one was after the peak in housing seen in 2006 and was known as the subprime crisis. 16 to 18 years prior to that was the peak in 1989, from which the savings and loans crisis became apparent. And 16 to 18 years prior to that was the crisis following the real estate peak in 1973. Other downturns also occur between these real estate peaks. In the 1980s, after a period of very high interest rates to tackle inflation, the US went into recession. In the early 2000s, as the dot-com bubble burst, markets and the economy also took a hit. In both of these periods, in between the housing peaks, interest rates were cut and looser conditions were put in place that further helped to fuel the rise in the real estate markets that was taking place in the background. Arguably, a similar pattern is emerging again today. The shock of COVID-19 has led central banks to cut interest rates to zero, expand their balance sheets, and governments to increase their deficits, thereby creating loose conditions to fuel a credit expansion. Mortgage rates are at their lowest levels, the interest rate curve is steepening, and signs in markets point towards the outperformance of housing relative to the S&P 500. 20 years ago, the same was happening as the Nasdaq fell and interest rates were cut down to 1%. Housing versus the S&P 500 saw a major breakout in favor of housing, something that looks likely again now. Importantly, the same loose policies that fueled the housing market in the second half of the 1980s and the early 2000s also sent the US dollar down. Consequently, we saw the simultaneous rise in real estate and a fall in the US dollar, which itself is a form of monetary easing. Again, a similar pattern is unfolding before us today. Despite the heightened volatility in March this year, 2020, the US dollar could not break through the January 2017 high, let alone go any further. Instead, it has now started to slip as panic has been arrested, and looks likely to continue in that direction lower until 2024, as housing will approach another high in the mid-2020s, some 18 years after the last peak.
Safe markets, getting ahead of the curve.